Have a nice day, everyone. How are you today? Today, I'd like to discuss another topic, and I hope it will be useful to you in your studies. Our topic is all about cash flow. Let's first examine the purpose and significance of cash flow figures for company. Next, after going over a sample cash flow statement. What is a cash flow statement? A cash flow statement is a regular financial statement telling you how much cash you have on hand for a specific period. While income statements are great for showing you how much money you've spent and earned, they don't always tell you how much cash you have on hand at any particular time. When you use accrual method, income and expenses are recorded when they are earned or incurred, not when the money leaves or enters your bank accounts. The cash accounting method only records money when it is on hand. So, even if you see income on your income statement, you may not have the cash from that income on hand. The cash flow statement adjusts the information on your income statement to show your net cash flow, the exact amount of cash you have on hand for that time period. For example, depreciation is recorded as a monthly expense. However, you have already paid cash for the asset you are depreciating. You record it on a monthly basis to see how much it costs you to have the asset each month over the course of its useful life. However, money does not literally leave your bank account every month. The monthly expense is reversed in the cash flow statement, allowing you to see how much cash you actually have on hand rather than how much you theoretically spent. Why do you need cash flow statements? So long as you use accrual accounting, cash flow statements are an essential part of financial analysis for 3 reasons. 1. They show your liquidity. That means you know exactly how much operating cash flow you have available in case you need it. So you know what you can and cannot afford. 2. They show you changes in assets, liabilities, and equity in the forms of cash outflows, cash inflows, and cash being held. Those 3 categories are the core of your business accounting. They combine to form the accounting equation, which allows you to assess your performance. 3. They let you predict future cash flows. To predict how much liquidity your company will have in the future, you can utilize cash flow data to construct cash flow projections. It is crucial for creating long-term business plans. Furthermore, if you intend to apply for a loan or line of credit, you will need to provide current cash flow statements. Let's talk about negative cash flow versus positive cash flow. When your cash flow statement shows a negative number at the bottom, that means you lost cash during the accounting period. You have negative cash flow. It's important to remember that long-term, negative cash flow isn't always a bad thing. For instance, in order to become successful, early-stage enterprises must monitor their burn rate. Positive cash flow for the month is indicated by a positive number at the bottom of your statement. In the long run, positive cash flow isn't necessarily a good thing, so keep that in mind. Although it increases your liquidity now, there are unfavorable reasons you might have that money, such as if you took out a sizable loan to save your failing company. It's not always the case that positive cash flow is good for business. Where do cash flow statements come from? If you do your own bookkeeping in Excel, you can calculate cash flow statements each month based on the information on your income statements and balance sheets. Using the information you've previously input in the general ledger, accounting software may generate cash flow statements. Remember that using either of those approaches only ensures that your cash flow statement is accurate if the rest of your bookkeeping is accurate as well. Hiring a bookkeeper is the most reliable approach to determine how much working capital you have. Your cash flow statement will always provide you with an accurate view of your company's financial situation, because they will make sure everything adds up. And we have the statements of cash flow using the direct and indirect methods. There are 2 methods you may use to determine your company's cash flow, the direct technique and the indirect way. Although both are permitted by generally accepted accounting principles, GAAP, small enterprises frequently favor the indirect route. 1. The direct method of calculating cash flow. With the direct technique, you keep track of the money coming into and going out of your company, then use that data to create a statement of cash flow at the end of the month. Since you must create and keep track of cash receipts for each cash transaction, the direct technique requires more organization and labor than the indirect way. Smaller companies often favor the indirect approach because of this. It's also important to note that even if you utilize the direct approach to record cash flows in real time, you'll still need to use the indirect technique to match up your income statement and statement of cash flows. This means that the direct way will typically take longer than the indirect method. 2. The indirect method of calculating cash flow. In order to determine your working capital using the indirect technique, you look at the transactions that are listed on your income statement and then reverse some of them. In order to exclude transactions from your income statement that don't demonstrate the transfer of money, you are selectively going backward in time. Many small firms use this strategy since it is easier than the direct approach. Also, you do not need to go back and compare your assertions with the direct technique while using the indirect method. We'll compute cash flow indirectly in the examples we provide. How the cash flow statement works with the income statement and the balance sheet. In your cash flow statement is made using data from your balance sheet and income statement. The balance sheet reveals how those transactions affected other accounts, such as accounts receivable, inventories, and accounts payable, while the income statement reveals how money entered and left your company. In order to create financial statements for your company, you need to follow these steps. Income statement plus balance sheet equals cash flow statement. Now that we have a general understanding of what a statement of cash flows is used for and how it is produced, let's look at an example. There is a lot to discuss here. To have a general sense of what this cash flow statement is doing, you must know the following. Cash quantities drop in yellow pesos. For instance, when growth in inventory is followed by 30,000 pesos, it signifies that the inventory on the balance sheet grew by that amount. Inventory was purchased for 30,000 pesos, which resulted in a fall in our cash balance of that amount. The white peso quantities bring in more money. Depreciation, for instance, appears next to 20,000 pesos, which is an expense on the income statement but doesn't actually reduce cash. So, we return it to net income. The statement of cash flows is divided into 3 parts: cash flow from operational activities, cash flow from investment activities, and cash flow from financing activities. This is something else you'll notice. Now, let's examine what the cash flow statement's various sections do. These 3 activity sections of the statement of cash flows designate the different ways cash can enter and leave your business. 1. Cash flow from operating activities. This is money that is made or spent during routine business operations, and it represents the primary source of revenue for your company, the sale of goods or services. 2. Cash flow from investing activities. This is money that your business makes or spends on purchases like equipment or investments in other businesses. And 3. Cash flow from financing activities. Is the money you make or spend when you finance your business using loans, lines of credit, or owner's equity. Here is a more thorough explanation of what each part performs and what it implies for your company using the cash flow statement example from earlier. The cash flow from operating activities. The majority of your cash flow will be used for operating activities in most small firms. This is because generating revenue comes from running activities. Example, if you own a hamburger shop, it includes both the money you get from selling hamburgers and the money you spend on ingredients and labor. If you are a licensed massage therapist, the money you make from giving massages and the money you spend on utilities and rent are both listed under operational activities. In our example, cash flow from operational activities. Let's take another look at this section and analyze it line by line. The amount of money left over after expenses is known as net income. The income statement provides this information. On the income statement, depreciation is shown as an expense of 20,000 pesos. It appears as income in this place. We are adding the 20,000 pesos back to cash on hand as no money actually left our hands. The revenue statement includes the increase in accounts payable as a 10,000 pesos expense. In this instance, let's suppose it's paying contractors to construct a new goat corral. That's money we owe. We add that sum back to the cash on hand because we technically owe the money but haven't yet paid it. On the income statement, the growth in accounts receivable is shown as a 20,000 peso increase. We charged our customers the money, but we haven't yet received payment. The money we charged is an asset, but it isn't actual cash. Thus, we take 20,000 pesos out of the cash on hand. In the balance sheet, the expansion in inventory is shown as a 30,000 increase. In other words, we purchased the inventory for 30,000 pesos in cash. Although inventory is an asset, it is not money because we cannot spend it. Thus, we take the 30,000 pesos out of our available funds. With the following adjustments, net cash from operational activities equals 40,000 pesos. In other words, even if our company made 60,000 pesos in October as shown on our income statement, we only really got 40,000 pesos in cash from operating activities. And the cash flow from investing activities. When you spend money on an investment, that money is turned into an asset of comparable worth, whether it be equipment, real estate, land, or readily liquidated financial instruments known as cash equivalents. This section covers investments your organization has made. You spend 10,000 pesos on a mower for your landscaping business, which results in a loss of 10,000 pesos in cash. A 140,000 pesos retail space costs 140,000 pesos to purchase. As a result, you lose 140,000 pesos in cash. When we reverse those investments, the cash on hand is taken out and recorded under cash flow from investment activities. Although they have cash worth, they are not the same as cash, which is the only asset we are concerned with in this situation. The majority of your company's cash flow for small enterprises typically won't come from investing activities. However, since it has an impact on your working capital, it still needs to be adjusted. In our example, the cash flow from investing activities in our income statement, the purchase of equipment is recorded as a new 5,000 pesos asset. It's an asset, not cash, so when we see 5,000 pesos on the cash flow statement, we deduct 5,000 pesos from cash on hand. The cash flow from financing activities, on the other hand, the money made or assets used for financing activities are covered in this section. Money leaves your bank accounts as you pay down a portion of your loan or line of credit. You gain money in your accounts when you use your credit limit, borrow money, or bring in a new investor. In our example, cash flow from financing activities. On the balance sheet, notes payable are shown as a liability of 7,500 pesos. We record the loan proceeds as a 7,500 pesos increase in cash on hand. Also, if the monthly cash flow, the total cash flow for the month is shown at the bottom of the cash flow statement as 42,500 pesos. We only received 42,500 pesos, despite the fact that the net revenue of 60,000 pesos that is shown at the top of the cash flow sheet and obtained from our income statement was ours. We have access to 42,500 pesos right now, if necessary. We could be led to believe that we have 60,000 pesos in cash if we simply considered our net income. In such instance, we wouldn't really know what we had to work with, and we ran the danger of going over budget, making bad financial decisions, or lying about our liquidity to potential lenders or business partners. That's all for our today's discussion, and I'm going to end up here, and hopefully I'll be able to provide some insight into our lesson that we had discussed. Please remember to subscribe, like, heart, and share if our discussion has helped you in your life, so that I can always be inspired to do more videos for you that may help you in your studies. Thank you very much, and God bless.